Today, I would like to welcome all of you for a very interesting discussion with somebody who's been a practitioner, business person, and now a researcher too. You rarely get that combination uh, between running businesses, actually working in the non-profit sector and the profit sector. We have Mr. Nachiket Mor, who in his initial years was known for his banking expertise, was a senior director at ICICI and later on ran ICICI Foundation. Welcome to Policy Talks, Mr. Mor. Thank you
Thank you.
for.
I'm pleased to be here.
Yeah. As you know, Mr. Moore, for the last couple of months, at least since the RBI appointed this new committee under the chairmanship of Shyamla Gopinath, where they are evaluating licensing for new banks. And they're supposed to, of course, the process is known as on-tap licensing, but this committee is supposed to give new licenses out. Now, you almost now, just less than a decade back, introduced in the concept of differentiated banking. Now, in today's context, where we have still not been able to meet our priority sector lending growth targets, or even properly measure them, what do you think is the role for differentiated banking licenses?
So, Mr. Rajat, I don't work in banking and finance anymore, so my information will be somewhat dated and maybe not as fully informed as you would like. But the problem that you outlined, particularly as we look ahead to pandemic recovery, and we say credit is an important part of the fuel, and people's access to financial resources, their savings, money transfers have become an important part of the government response. Again, accessing that, getting that smoothly, my understanding, it continues to be a problematic area. One is, of course, you mentioned in our previous discussion, there are some sectors that are starved. I am actually much more concerned about regions that are credit starved, because I believe sectors are a subset of the region, the competitive capability of a particular region. The region must decide, but the region must get access to credit. And unfortunately, the overall Indian banking system continues to be underpowered relative to the need. Credit to GDP ratio is still not the 200, 220% that you think a rapidly growing economy like ours should have. And this is the national number. In many parts, many states, that number is much lower. You see, you hear talk of numbers like 20% credit to GDP ratio, 25% credit to GDP ratio. So clearly, there is a gap. And then the question you would have is, if there is a gap, what is the best way to meet it? What can the regular banks do? Is there a role a differentiated approach could help us provide? Now, the idea of differentiation is not necessarily new to India. We've always had cooperative banks, regional rural banks. The RBI had experimented with the local area bank earlier.
Yeah.
I think the idea that, this committee that I happen to chair, we explored was not so much differentiation per se, but differentiation along what lines. The original, what lines, what dimensions differentiation should take place.
Mm-hmm.
A lot of the earlier differentiation was around size, around ownership, around focus of business, but you didn't see differentiation around dimensions.
Dimensions like
now, at that time.
Dimensions
yeah, at
like
that
sectors?
time. No. So let me just give you a sense of what the issues at that time were. Not all of them may be relevant today, but those were issues then. One was that the business correspondents that were supposed to take payments to the last mile were financially not viable, because after much work, it was clear that the low-income communities, rural communities, remote communities didn't have enough activity, financial activity, to allow an individual to financially run a sustainable, exclusively doing this business. There was a need, therefore, to think about, is there a way this cost conundrum can be taken care of?
Between the branch, business correspondent, physical presence of a branch, a business correspondent, and the model per se.
And the customer, right? There was some issue there that needed to be addressed. Second, there was this issue of, and again, I know there's a lot of debate on this, corporate ownership of banks. Should they be allowed? Should they not be allowed? Now, there is clear temptation to bring them in because they bring a lot of capability that could be beneficial. Deep presence on the ground. If I look at a fertilizer company, if I look at a mobile phone company, if I look at pharmacy chains, they bring a presence on the ground. And they also bring an existing fixed cost base that's already been paid for by other businesses, what we call adjacencies.
A domain expertise also.
They bring at least the understanding of the local area. They may not bring domain expertise in finance, but they certainly bring domain capability in what we call the real sector. But the challenge, of course, with corporate ownership is this whole issue of self-dealing. Right? There is a concern, which is why now worldwide you have gone away from corporate ownership, because there is a concern that when crises hit, corporate-owned financial institutions tend to lend money at preferential terms to other parts of the businesses that they own. Right? In particular, the concern was around retail deposits. How could they be protected against self-dealing? Because the belief is that the wholesale depositor perhaps is a smarter, more intelligent depositor and will take care of their own needs. The retail depositor, that's the problem. The third issue, which again, was an important issue that needed to be addressed, was, we've dealt with the issue of, adjacency. We've dealt with the issue of self-dealing. At least there's a concern there. The third issue is, what about infrastructure financing? Many countries, including India, have tried the DFIs, the variety of models. For a number of reasons, they have not necessarily worked as well. Partly, one of the issues, for example, was that an ICICI, I lend the money, but I don't control the cash, because the cash sits with somebody who's called a bank. Right? So I don't have control over the waterfall, which is an important tool that I want to control. And then if you have a situation in which, currently for a variety of other reasons, if different cost structures exist in different parts of the ecosystem, trying to compete with the same structure, regulatory unevenness creeps in depending on the exigencies of the moment. Again, that became a problem as to how do we deal with it. Right? So a lot of our differentiated thinking was informed. There was a fourth factor as well, which was, many African countries have taken lead in allowing payment providers to come in, wallet providers to come in. They've become very large.
We've seen that here.
There was a concern that would this threaten systemic stability? That if you started to build non-bank players that were very large, and they were connected to some small bank on the ground, are you building in connectedness? Tomorrow, if this large player, because of other concerns in their business, fails, what happens to systemic stability? Is that okay or not? And there is a detail, which is yet another issue around Banking Regulation Act, defines a deposit as putting money in and taking value out. At that point, the understanding was that function can be performed only by a bank or bank-like institutions, because there is a money multiplier concern. The minute you have money coming in, money coming out, high-powered money, then you create a money multiplier. And you're not, unless you have reserve banking there, you have some reserves, you're not able to control the level of money creation in the system.
Yeah.
This produced the architecture that at that point we thought made sense.
But now that environment has changed substantially. I mean, we've seen the fact that payment itself has become a very large segment. Payment transactions particularly have moved away from banks. Payment banks have, of course, collapsed, but digital wallets have become so large that they are, they've raised billions of dollars in risk capital. They're thinking of doing IPOs. So that segment of the industry has kind of evolved with a lighter regulation. While the deposit part and the credit part is still enough, what would I call a fair syndrome, where the regulator feels that if something were to go wrong, then there will be a very high systemic risk. Hence, the regulator is not wanting to take any risk, zero risk, and does not want its players also to take zero risk, because one, maybe it does not have the capability to manage this. So it says, let's not take any risk. And that is where your corporate example also kind of bears fruit. The other is that because there is this approach of zero risk versus segments of the market still being developed on its own, we have an anomaly of sorts existing now. And credit still is a challenge. Look at which is making certain segments of the industry non-competitive. Like, for instance, logistics. It's non-competitive from a global standard because the cost of credit is high. Agriculture, we still, you worked on NABARD. Agriculture, we still see credit being high and credit being, pushed under RIDF kind of segment. So do you think there is we've reached a stage, at least some maturity in our regulatory environment, that we should start thinking differently in terms of banking and deposits and the risk that institutions or banks should be able to carry?
As I said, you're quite right. Things have changed. So I'm not totally au fait with everything. I certainly, as an outsider now, would be very concerned about the growth of the payment industry without the banking regulation being applied to them.
Explain.
Because in fact, that's the very issue that we were trying to protect against. Mm-hmm. A large wallet emerges, which doesn't have a capital requirement, doesn't have a reserve requirement, is now depositing money with a subsidiary small bank.
Yes.
This is exactly what we are concerned about for Africa at that point.
Mm-hmm.
Right? What if some of these players fail? Right? The shock through the system could be enormous. For a variety of reasons, I don't know the details of it. When you say lighter regulation, somehow the word bank seems a heavy word.
Yes, it does.
What we had tried in the committee was to lighten the word itself, to say, what do you mean by lighter? Do you mean I should not have conduct regulation? I should not have capital requirements? I should not have some reserve understanding? Well, if all that calls a bank, is that all that means we call it a bank, then why not call it a bank? Why not pretend it's not a bank when it is actually performing those exact functions? So, again, as you correctly point out, things have changed. I don't know the details of that thinking. But as an outsider, I would certainly be concerned about, in fact, in the committee, we had recommended that no more wallet licenses to be given, and gradually all wallets to be persuaded to come into some form of a banking frame, and given the rights and the responsibilities of a narrow actor, and allow corporate entry in an unfettered way into that segment, because they have, why not a Hindustan Levers? Why not a Big Bazaar? These are entities that deal with cash, deal with customers, so long as they cannot lend money.
And they don't take deposits.
No, deposits they can still take, because when you say wallet, see, that's why it's all wordsmithing, right? At the end of the day, a deposit is value transferred for consumption later and value withdrawal. That's a deposit. That's a wallet. Just because we called it a wallet doesn't mean it didn't become a deposit.
Yes.
Right? It's a matter of how do you want to think about systemic regulation independent of words. What are the underlying principles you're trying to work with, right? Now, on the issue of credit, I mean, clearly there is, kind of a number of challenges that we are, I mean, there was a design that was at one point a popular design, which continues to be available to us, which is a design that, in a sense, started with the Nasiman Committee 1991 frame, in which there was a notion, and then RBI took it up, in terms of how it regulated it, thought about it, because the Act itself doesn't cover it, is the notion of, banks and what one would call non-banks. And unfortunately, these non-banks are referred to as shadow banks, but actually shadow banks are more like insurance companies and mutual funds, because they actually perform the deposit-taking function. And the shadow banking means you perform a bank-like function, which in India is defined as deposit-taking, because that's what the Act says. So those are the shadow banks. These are non-banks. We have chosen, for a variety of reasons, to think in the banking frame and try to get everybody either as a bank or in some ways to gradually wither away. Right? Now, the point you make is that if I've got a deposit-taking institution, do I really want to build a high-risk business from it? If a bank is not lending to a remote area in the Northeast, well, it is performing the function it was designed to perform, which is to make sure that the safety of deposits and because banks are very highly leveraged, right? Bank, if I look at the debt equity ratio of a bank, it can be as high as 1:20.
Yeah.
Right. So such a high leverage, from Finance 101 cannot have a lot of revenue volatility, because then it immediately translates into default. So, now the question is, are we inadvertently creating safer non-banks and riskier banks?
Is that what you see happening in terms of?
Because effectively what we are doing is we put massive capital regulation on the non-bank finance companies.
Yeah.
We define systemically important at a very tiny threshold
Can be
for
let
NBFCs.
Yeah.
But we have a huge threshold for what a bank is when it's systemically important. Right? And I am certainly concerned as an outsider that this is driven more by competitive concerns than by prudential concerns. And the desire to make the non-banks less competitive relative to banks, but in the process, actually becoming less prudent about how you're managing the system. Because the original idea was the non-bank is not a bank-like entity, it's a corporate-like entity.
Yeah.
Right? It does not actually need to be regulated except as you would regulate a corporate. Right? And a bank as a lender is de facto an internal regulator of the corporate. If a corporate borrows a lot of money from a bank, the bank decides how it would regulate the corporate's behavior vis-a-vis X, Y, and Z. And the Reserve Bank of India operates via the bank to ensure that there is some prudential norms being followed. Why is there a need to go beyond this structure and to directly capital regulate these entities? Right? I mean, I would, my own instinct would be in the remoter parts of the country, in the high-risk business of the country, encourage the non-banks to go out there. If they fail, they fail. Obviously you cannot allow them to get to 50,000 crores and 100,000 crores. So there are clearly another problem that we have. We have very large non-banks, which are systemically truly important, more than 100,000 crores.
Yeah.
That are not being gradually nudged into banking.
And they're being nudged into banking. You're right. Interesting point. They are being nudged into banking because they already are. They do everything else.
No, but then it comes in. The problem comes to the corporate ownership of many of these institutions.
I don't know
which is where
fear of corporate ownership is still true in today's liberal world.
I mean, I would submit to you, it should be.
It should be.
It's a real threat. We have seen worldwide this is a problem. But at that point, we had felt that the wholesale bank route offered a nice route for many of these entities to come into the banking fold, but not be concerned about self-dealing because there's no retail deposit taking capability. All you're doing is taking large deposits. In fact, India is one of the few regulatory environments. For example, if you open a bank in the US, you're not allowed to take retail deposits until you are able to convince the regulator that you know the first thing about banking. You might be a big shot bank.
But US also allows you to kind of figure out your own business model as you want to follow in banking. They don't insist that you need to do.
I'm making a simple prudential point. In India, we force everybody to become a retail bank.
Yes, and a universal bank at that, yes.
The wholesale bank point was, why do you want a JP Morgan or a Goldman Sachs? They're not really retail banks.
Absolutely. Or even a Deutsche Bank.
Or a corporate entity, right? That is running a non-bank finance company, is not doing retail deposit taking, right? Or if they are, go back to them and say, cease your retail deposit taking. We will give you a banking license, but you can only take wholesale deposits now. You can only borrow from other banks. That allows you to bring these larger systemically important institutions into the fold, allows you to take away the concern about corporate ownership, because now there are no retail deposits. And, in our report, we had made a distinction between wholesale investment banks and wholesale consumer banks. A Bajaj Finance, for example, would become a wholesale consumer bank, right? A JP Morgan would become a wholesale investment bank, right? Because it could not only borrow only wholesale, it would do only investment banking type business. Right? Now, our feeling was that along these dimensions, if you took the bank balance sheet and you said there is wholesale retail deposit taking, there is wholesale retail lending, and then you allowed some permutations, combinations to emerge, many of the concerns that we had might not be as material. And then a corporate-owned entity could be told 5 years down the line that if you dilute ownership, and if you tomorrow become a professionally held, broadly held institution, we will take away this restriction of the wholesale deposit. You can become a full service bank, but that's your choice. Then because in a way, the Banking Regulation Act doesn't have any multiple licenses. Small finance bank license, large, not a BR Act issue. The license is the same banking license. It's an additional restriction you get as a form of a letter saying you may not do X, Y, and Z things. It's more regulation rather than the act that is deciding this. So it's a relatively easy matter for a payment bank to be told, you want to lend money? Fine, right? From tomorrow you can. I don't need any other process because I've already licensed you as a bank. It's a simple letter. I move forward and backward. It seemed to us like a consistent single strategy dealing with multiple sectors.
Multiple models?
Balance. All models coming from, but multiple models coming from the same frame. It's like when you build a car, the underlying chassis is the same. You've got multiple things attached to it, but you can move from one to the other with relative ease. You can make sure there's no regulatory arbitrage emerging. You're not moving from one type of regulation to another type of regulation. They're all being regulated by function rather than by form. So if you don't take you don't lend any money, then you have no priority sector requirement. You have no credit risk capital requirement.
But now, if you were to look at the scenario now, we have the payments bank which collapsed because they could not lend or collect deposits, and their whole business was taken away by the wallets, basically digital wallets. The small finance banks, which were supposed to be a kind of a front runner for regional disparity of credit, as you pointed out in the beginning, and to enable financial inclusion and priority sector lending, are struggling in the sense that they're not growing, they're not able to do priority sector lending. Their regional growth is restricted. I mean, in the sense,
would dispute both your statements, though.
Okay, please.
If I look at the data on payment transactions, the leaders are all payment banks. So I don't know where you're getting the information from that Paytm has collapsed and Airtel Money has collapsed. These are the largest players.
So
The
Airtel Money
expectation was there'd be 3 or 4.
Yeah, Airtel Money is actually very small in that sense. If you look at compare it with a Paytm.
No, I'm saying in terms of balance sheet size maybe, but the idea of this was not a balance sheet business. This was a transaction business.
Yes.
It was very much intended to provide small individuals with small access. So the correct benchmark to look at is transactions and to understand what is the role these players are playing in outreach and transactions. My understanding is, for example, Airtel Money has 5 lakh branches, is the largest single financial institution in the world by branch network. Right now, of course, you're right. It has to figure out its business model so that, but that business model figuring out has to happen combined with the existing business. Does it, for example, reduce churn on their postpaid business? Does it reduce churn on their prepaid business on the SIM card? Because the idea of the adjacency was that the two would come together. Right? The small finance banks, my last recollection is that you're completely wrong. They are doing extremely well. Their market valuations are very high. Their NPA record is much better than that of the larger banks. And they are focused on the target client that you want.
So let me define success for SFBs. They were supposed, one of the objectives of giving them licenses was that they will help in reaching credit to the small borrowers, and they will help in reaching the priority sector lending targets. If you see the last 6 months, even as latest as last month, small finance banks have not been able to meet their PSL targets. Okay, and the reason all of them have cited is because they cannot afford to grow branches in the rural areas. They're saying that it is not possible for us with a small loan size to create a branch network. Hence, we are not able to reach out to either from deposit point of view or from lending point of view in those areas. That's what the failure is, not of the market valuation and the growth that they are seeing in terms of converting their MFIs lending into banking sector. So I'm saying the fundamental objective of setting them up has not been met. So we are likely to see a
consolidation. That's too quick. That's too quick, right? Okay. They have been at it. The MFI business has been throttled by regulation for the last 20 years.
Yes.
You've just allowed them to come in and raise low-cost deposits because the earlier approach pancakes capital. If I trace, for example, if I look at an MFI and you say, I'm charging 10% interest rate, right? Much of it is driven by regulation. Because if I take the money that I got from a savings account holder of, say, State Bank of India, 3.5%, State Bank puts capital, then it lends to an MFI by regulation. Then MFI is required to put another layer of capital, pretty high level of capital, before it lends to customers.
Absolutely. The cost of capital for MFI is equivalent to
no, not cost of capital, the pancaking of capital.
Okay.
It's a word that comes from power sector. When you transmit power from state to state, you pay each state a certain money. So what is happening is that the capital level required by law goes up dramatically. Right? Now, why is it that that should happen? For a variety of reasons, the regulation said, unless you become a bank, pancaking will be required for you. You raise your own money. I'm submitting to you that reduces risk-taking capacity in the system. But that was the law, right? Now the question is, can you judge their success within 3 years of having gotten, started, right? That's too quick, right? Because it will take time for them to settle down and what to say. Now, you may have a deeper question as to why were they forced to move from NBFC to SFB? What exactly did we achieve by that transition? Were we not better off them continuing as they were? And maybe think of them more as wholesale consumer banks rather than in this current structure, because they're all kind of small. They're not doing, because as soon as you become a bank, right, you have to worry about the depositor now.
Yes.
You can't do the same thing that you were doing when you were a MFI. Because there, if you fail, you saw the Andhra MFI, several of them failed, in the 2008, 2010 crisis. It wasn't a systemic shock. It didn't bring the banking system down. It didn't create a run on the deposits of these institutions.
They were not collecting deposits in that sense.
But now they can't afford to do all that. Now they have to be as careful as everybody else. So, I think it's too quick to judge. I wouldn't necessarily suggest that the answer is more differentiated licenses there. I think they will, you need to bring them into some form in which this pancaking issue disappears as a problem for them. They can actually get the benefit that they could have gotten if the pancaking was not there, of a low-cost bank deposit base. But since the law didn't permit that, this transition allows it.
So, this pancaking issue, or as you say, this conversion of a non-bank into a bank, and then the deposit, the preventing or securing the deposit, so to say, also has a larger systemic impact in terms of the cost of lending, or the cost at which a NBFC or a SFB can lend. Now this in the long term also impacts the competitiveness of certain sectors. We've seen from the China example, at least, that the capital cost was an enormous element in the success of numerous sectors in their economy, whether it was the large electronics manufacturers or even the steel and the cement plant, which could access capital at so-called control rate of credit. Now, when you look at this and you look at cost of credit and competitiveness of a country, where do you see these balances and these so-called relaxation or leverages happening in our over-regulated so-called banking environment?
The key issue to track is real interest rate, right? And to understand how real interest rates are behaving in multiple economies. There used to be, I don't know how credible that benchmark is, a 2% real interest rate as a reasonable real interest rate, right? Which is fair to depositors and not unfair to lenders, right? In India, there has been this concern that what is the underlying core inflation? Because if you look at the risk-free interest rate, right, it's actually been trending downwards. It's not necessarily as high as one would imagine it should be. The issue is what you're saying is the risk-free rate might be low, but the rate at which an entity can get money, right? Can they get money? So there's an access issue. I would submit to you that for an SME, for a municipality, for a low-rated large company, access may be an equally big problem, not just cost.
It is. Both are problems,
Then the question is what happens to inflation? What are we thinking about in terms of our projected inflation number? Because you can't compare Chinese interest rates and American interest rates without factoring in what is the real number, right? In an economies where inflation rates are near zero or very close to zero, right, and very stable, you will get even the AAA rated rate. So, right, so there is a risk-free rate, there is the AAA rate, and then what you're saying is, what about the AAA to single B? That curve, what we call in banking, when we look at one of the ways in which you evaluate whether a financial system is working well or not is what is called credit risk ordinality. Are two people of the same risk getting money at the same rate? Are people with a lower risk getting money at a lower? People with a higher risk, are they getting money at a higher risk? Right? Clearly, if I look at, and this is a paper that me and a colleague of mine had written in 2004, I'm happy to send it to you, in which policy-induced uncertainty does produce credit risk volatility. That has to be priced in by any lender. Right? There is no way that we can, quite aside from pancaking, quite aside from all these issues, if I look at infrastructure finance, for example, right? Why are interest rates so high to long-term infrastructure projects, even where risk has been taken care of? There's a great deal of what we would call policy-induced uncertainty associated capital.
When you're referring to the policy, which policy are you referring to? Monetary policy?
I mean, for example, no, government policy. And on, for example, what should be the tariff rate on a road? What should be the tariff rate on a power structure? If tomorrow suddenly you tell me that I'm not going to be able to charge toll, then as a lender,
yeah,
I have to price that into my. Now it's possible other high inflation countries have controlled
that
the policy uncertainty, right? Which then means a banker doesn't have to, commit, has to, build that into the charge process, right? There's also the other issue, which is one more logic why we thought a wholesale investment bank made a lot of sense, is domain capability, right? A generalized bank, is it able to bring the domain capability to fund power, road, steel, cement?
Yeah.
Or is it better for them to become a participant in the market and buy high-rated securities?
Bonds of this.
But the wholesale investment banks, who are deeply specialized, and the wholesale consumer banks who are deeply specialized in home loans, in power plants, in steel plants, they actually lead the charge because they bring narrow capability, in the domain that they have. Right? So again, it's possible that some of this can come together, in a overall system.
How does it come together? I mean, like, for instance, can you have domain specialists in segments like, for instance, logistics or MSME, even agriculture? Do you think that we need domain specialist banks in these segments? Because I mean, nobody is actually able to lend to a farmer, frankly speaking. I mean, NABARD makes a joke of lending to farmers, but it actually lends to state governments who, in their turn, say that they are lending to infrastructure which is going to be used for farmers. There are MFIs which have rightly judged or understood the risk or credit presence of farmers. And so therefore, domain expertise is really very important if you want to even reach out to the unbanked, whether they are in the MSME sector, they are in the logistics sector, they are in the custodian segment or agriculture sector. What can be done there to make that happen?
No, I mean, again, we go back to the differentiated issue, right? Why do we not want the non-banks to have domain capability? They do have.
They already have.
It's not just domain, right? So why not? Why do we need to attach the word bank to it? Right?
Yes.
There are entities there. Look at why they are not more competitive. They're not more competitive because you don't want them to be competitive. You want them to actually move, either disappear or convert to a bank. Because
is that because of the fact that RBI do not want people who are unregulated by it to be managed by them? So they think that if I want to regulate it,
regulated by them. Nobody else regulates them. And see, at the end of the day, will I take a corporate and say, since they are using money, RBI should regulate them? It does regulate them via the bank.
Yes.
Why not the same approach here? What is the intent of regulation? Good behavior.
That's an interesting question. That is a very interesting question. Yes.
They are systemically not important. Why would you not allow an entity with 300, 500,000 crores of balance sheet to go out there and do domain capability linked, and tomorrow there is a large risk that they fail? Well, the bank that lent to them should have built a portfolio that can absorb that failure. Right?
But
and 20 other fellows will come.
Shouldn't they be allowed to take deposit to reduce their cost of capital?
No, see, the cost of capital is coming because of pancaking. Otherwise, why would somebody require, if I'm borrowing money from a large bank, which has a cost of money of 3%, right? Why can't my MFI?
They will not lend me back at 3%. They will add.
That's decided by regulation, right? Because it's decided by how much capital you insist.
Yeah.
That everybody needs to keep.
So a kind of a differential model for non-banks who borrowing from the banks. Is that what you're saying? Who are domain specialists?
No, I'm saying the view I would take, I've written also about this, treat the non-banks as corporates, not as bank-like entities. They are not bank-like entities. Treat them exactly like you would treat a corporate, right? Let the banks worry about it. Why do you want to get in there and worry about it? If they cross a certain size, say 50,000 crores, then nudge them towards a banking license. Many of them are owned by corporates. You have many differentiated choices you can use to accommodate corporate ownership without losing domain capability. But do not allow them to continue as non-banks beyond 50,000 crores.
Beyond
Because
50,000.
then they become systemically, some number. I mean, I'm just coming up with a number, 50,000 crores, some very large number, comparable to what you would say a bank you would consider. Now, the bank number should be lower, the NBFC number should be higher, because the bank takes deposits. So you would worry a lot more about it. Currently, it's completely the opposite. A bank is systemically important at a very high ceiling, and NBFC is systemically important at a tiny number. Right? As I said earlier, I think it's dictated by competitive concerns, because the worry is that the NBFC is more nimble at a much higher cost of money. It's still able to compete with the bank. Why not bring them into a certain fold once they cross a certain threshold? But below that, remove capital regulation. Allow the banks to decide what is a sensible. That's what they do for any corporate.
Yes.
Right. RBI doesn't say when you lend money to steel companies, they should have capital adequacy ratio of 45%. They don't say that. Banks decide, is it sensible, is it not sensible? And then, whenever we are able to get to the Ind AS point, Ind AS will force banks to mark to market or mark to model these loans.
So, I mean, technically speaking, say for instance, the Shriram Finance should not be nudged to become a bank. It should, bank should treat it as a corporate so that it is able to lend better to a logistic.
It's a very large entity, so I wouldn't necessarily use that as an example. I would use a smaller, non-bank finance company as an example to say, they would treat them like any other corporate.
So, is
larger
that
entities?
Is that happening because of some kind of a regulatory history where we have seen a lot of NBFCs, even small ones, collapsing? We saw during your 90s period also a lot of NBFCs collapsing. So then RBI kind of pulled back everything and said, control everything, insisted that this is how things should be.
I would submit to you NBFC collapse is desirable.
It's desirable.
Because this is what the flip side of risk is. You can't say that you take risks, but do not ever fail. Taking risk means you will fail.
It's desirable, right? And it's cyclical.
It could be cyclical. It could depend on, and you then have to have a bank that is able to understand the risk. And you can't tell me that a bank understands steel risk, but doesn't understand the risk of an NBFC. Because NBFC is actually very similar in terms of skill sets to what it itself does. So if anything, banks are very competent to be internal regulators of NBFCs and much less competent to be internal regulators of infrastructure projects.
So I just wanted to summarize our discussion, Nachiket. We've kind of crossed our borderline here. 2 or 3 interesting ideas that are coming out from this discussion. One is, and correct me where I'm, or substantiate it where I'm not able to explain it fully. One is, of course, the aspect of treating non-banks as corporates and allowing them to lend as the corporate instead of burdening them with the requirement or burdening the banks with so much requirement that the cost of capital to them automatically becomes too high, right? That's one.
Banks and the NBFC. Yeah. Right? Yes. It's not simply the bank. The NBFC is required to keep even more capital than the bank is required.
Yeah. So free that up. Now, where do you see this freedom coming from? Do you see it in any existing discussions? Like, for instance, I remember that in 2017, RBI had released a kind of a discussion paper on wholesale banking and long-term finance banks and all that, but it didn't go anywhere. So where does these things actually get stuck? What your idea is, it's discussed, it gets to a little academic rigor in terms of research and shape, but then it gets lost. Why does that?
Obviously, any such decision making of such an important nature would need consensus between Ministry of Finance, Reserve Bank Board, Reserve Bank staff. See, consensus is important in this. Banking is not a business where you turn on a dime, you do things. You have to go carefully to it. It's possible that I don't know what happened, but all I can say is that it's possible a consensus was not possible to reach. And that there was some issue. On the other hand, on allowing a lot of wallet type players to emerge without capital controls, maybe there was consensus.
That is an
that
interesting
it was
point.
okay.
Yeah, you made that point earlier that having such a large wallet oblique payment transaction industry, which is unregulated largely, you feel that is almost like a systemic risk to.
I mean, the idea of the payment banking was designed not as a separate idea, was to actually take the same wallet and give it a slightly better, systemically, consistent regulatory structure. It was not intended. Payment bank, my understanding, was not intended to be a new entity. It's the same wallet with better regulation, called a payment bank.
Yeah, so that's interesting. Wonderful. What Nachiket will have to do maybe is, I will reach out to you again for the health sector conversation. I wanted to, this is an interesting conversation. I want to keep it here.